Right now, there's just a lot of uncertainty swirling around the global economy.
Yeah, definitely. We felt that jolt back in early April.
Right, with the U.S. administration's tariff announcement, Liberation Day.
And that came after a pretty fragmented first quarter, Different markets doing different things.
Exactly. Which leads to the big question so many people have. What do you actually do when you just don't know what's coming next?
Well, the easy answer seems to be just, run to cash.
Seems easy, yeah. But is it smart?
Well, that's the thing. Cash feels safe, sure, but holding loads of it means you're probably missing out on potential growth.
And inflation nibbles away at it too.
Precisely. Plus, trying to time when to jump back into the market, that's notoriously tricky. There's a real opportunity cost there.
Okay, so hiding in cash isn't the simple fix it might seem. So today, we're going to dig into some strategies that are actually designed for these kinds of, murky water.
Right. We're talking diversification, dynamic exposure management, using volatility, and systematic risk controls for those big unexpected shocks.
Exactly. We want to really unpack these, look at the theory behind them, what the results tend to look like, and crucially, what the potential downsides are too.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, let's start with diversification. It's kind of the bedrock, isn't it?
Especially now, with markets feeling so fragmented. Predicting who's going to outperform seems, harder than ever.
Absolutely. So diversification, spreading your investments across different places, different types of assets, it's a fundamental tool for managing that overall risk.
We saw a bit of that coordination, didn't we? After the tariff news reversed a bit, markets bounced back together, kind of mirroring how they fell together earlier.
We did, although policy divergence between regions is still pretty high. That suggests we might see more regional dispersion, markets moving differently in the medium term.
So just buying a standard global index like the MSCI ACWI, that gives you diversification, right?
Well, yes and no. It is global, but the way it's typically weighted, by market cap.
Ah, okay, so the biggest markets get the biggest share.
Exactly, which means it often ends up heavily tilted towards the U.S. Our sources show this pretty clearly.
So what looks global might actually be sort of a concentrated bet on the U.S., which could be risky given potential policy shifts or valuation worries there.
Precisely. That's a key point for you listening. You need to look under the hood of these global funds to see the real regional weights.
So what's the alternative then?
One approach is what's called a risk-based allocation.
Okay. How does that work?
Instead of weighting by size, it tries to balance the risk coming from each region. So maybe you allocate less to a bigger, potentially riskier market and more to smaller, less risky ones to even things out. The theory is that by avoiding that over-concentration, especially in the U.S. perhaps, you might get better risk-adjusted returns over the long haul. It's about not having all your eggs in one basket, risk-wise.
Okay, so diversification helps with what to own. Now, let's talk about how much to own at any given time. That leads us to volatility, right?
Yes, volatility-based allocation. It uses market volatility, basically. How much prices are swinging around as an objective signal.
Objective being the key word there. Takes the emotion out of it.
That's the idea. The core principle is pretty simple. When volatility spikes up, signaling more risk or uncertainty.
You reduce your exposure, maybe hold more cash.
Exactly. You systematically dial back your investment level, and then as volatility comes back down, you gradually dial it back up.
So it's not market timing, trying to predict the peaks and troughs.
No, not really. The crucial thing here is that you're trying to maintain a more consistent level of risk in your portfolio, rather than a fixed dollar amount that gets riskier when markets get choppy.
And we saw this signal back in April 2025, right? After the tariff news.
Yeah, sources indicated that various volatility measures were flashing yellow, suggesting it was time to trim exposure.
Okay, so how does this volatility adjustment work with diversification? Do they clash?
No, they actually work together quite well. If volatility flares up in, say, European stocks within your diversified portfolio, that market automatically becomes a bigger source of risk for your overall portfolio. The volatility-based system would then trigger a rebalancing.
Ah, so it would reduce exposure specifically to that now more volatile European part.
Potentially, yes. Or adjust overall exposure to bring the total portfolio risk back in line with your target. It keeps the diversification effective even when different markets are experiencing different levels of stress.
Right, that makes sense. It's dynamic. Diversify the holdings, then dynamically adjust the overall exposure based on market jitters.
Precisely.
But what about those really big out-of-the-blue events? The market crashes, the things standard models don't predict so well, the fat tails.
Yes, fat tail events. Those extreme moves that statistically happen more often than you'd expect based on a normal distribution curve.
And they can really hurt your capital.
Immensely. They can cause significant drawdowns. That's where systematic risk management comes into play.
Okay, another layer. What does that involve?
It uses objective factors, again, things like volatility trends, market momentum, how correlated different assets are becoming.
Similar signals to the volatility scaling.
Similar signals, yes, but often used to create specific overlays for the portfolio.
Overlays, like a protective layer.
Kind of. Think of it as an automated system that monitors these risk indicators. If they signal a period of heightened stress, like correlations spiking and markets trending down,
It can pull back overall exposure even further.
exactly. It modulates your investment level based on these broader market stress signals, aiming to limit the damage during those really severe downturns.
Okay, that sounds good in principle. But the source material also mentioned whipsaw events. What are those?
Right, that's the potential downside. A whipsaw is when volatility spikes sharply, the system tells you to reduce risk.
And then the market immediately snaps back up.
Exactly. And you've reduced exposure just before the rebound, so you miss some gains. In hindsight, the risk reduction feels unnecessary, even frustrating.
So there's a cost to this reduction.
There absolutely is. That missed upside in a whipsaw event is essentially the cost of protection, or the insurance premium you pay.
Okay.
The crucial insight is that you're accepting that cost for the potential benefit of avoiding those catastrophic portfolio-wrecking losses during a genuine crisis. It prioritizes capital preservation in really bad times.
And this relates to something else mentioned, volatility drag or variance drain. Why is just the level of volatility important long term?
It's a really key concept for compounding. Think about it. If you lose 50%.
You need to make 100% just to get back to even.
Exactly. Losses hurt your compound growth much more than equivalent gains help it. Higher volatility means bigger swings, both up and down.
And those bigger downs really drag on your long-term compounded return.
Precisely. Even if two portfolios have the same average annual return, the one with higher volatility, more ups and downs, will likely end up with less money over time due to this variance drain.
So managing the volatility itself, smoothing out the ride somewhat, is critical for long-term wealth building.
It really is. Successful long-term investing isn't just about making returns when times are good. It's also crucially about protecting your capital when things get rough. These systematic approaches aim to help with both sides of that equation.
Okay, so to bring it all together, we started with this feeling of uncertainty, not knowing what's next.
Yeah, and the reality is we don't have a crystal ball. Predicting market moves consistently is, well, arguably impossible.
So in that context, focusing on these strategies, good diversification, dynamically managing exposure, using objective things like volatility, and having systematic controls for those extreme risks.
It offers a more robust, more resilient path forward for the long term than just trying to guess right all the time.
And we need to accept that sometimes, like with those whipsaw events maybe we saw a bit of in 2025, these strategies might lead to reducing risk at what feels like the wrong moment.
Yes, that's the trade-off. That's the potential frustration. But it's weighed against the potential benefit of avoiding much larger losses and ultimately enhancing that long-term compounding effect by managing volatility.
Which leads to maybe a final thought for you listening.
Given how hard prediction is, how much weight should you really put on forecasting returns versus proactively managing the risks you can measure and control?
What does that imply for how you actually build and manage your own investments day to day? Something to definitely think about.